Thank you all for joining us today. My name is Kimberly Mills, and I am the Marketing Manager at Birchwood. I will be moderating today's presentation. At any time during today's webinar, you have the opportunity to submit your questions by clicking on the Q&A on your menu at the bottom of the page. If you just move your mouse around, a little menu should pop up. We'll attempt to address all your questions, but in the interest of sticking to our 30-minute allotted time, we will be sending a follow-up email that will include the recorded webinar, a copy of today's slides, and any additional Q&A. Rest assured, we will reply to all of the questions one way or another. So please feel free to submit questions as we go. We are so pleased to share our knowledge on sustainable, responsible, impact, or SRI investing with you. Here to share their insight in this rapidly growing area of the investing landscape are Kay Kramer and Steve Dixon. Many of you may already know Kay and Steve, but for those that don't, Kay is a financial advisor and the co-founder of Birchwood Financial Partners and has spent over 30 years of her career in this industry. She co-founded the firm 28 years ago and has had an interest and passion for this topic the entire time. Steve is the investment manager at Birchwood. He is responsible for the investment strategy for all of Birchwood's clients. He has been in the industry for nearly 20 years, 11 of those at Birchwood. Both have extensive experience in SRI investing and are excited to join us now. Kay, I'll turn it over to you.
Thank you, Kimberly, and thank you to all of you who have joined today. As Kimberly mentioned, I have been involved in SRI investing for a long time, and it's so exciting to see this style of investing evolve and grow over the years. It's changed a lot. And for those of you who may be new to SRI investing, we're going to start with some background on where SRI investing began and how it has evolved to being a more mainstream integrated investment style. We welcome your questions, as Kimberly said, as we go, as we know you all may be joining us with a varying degree of knowledge or experience. So, question away. So, Birchwood, a little bit about Birchwood in terms of who are we and how do we do this? We are a fee-only financial planning and investment management firm. And our firm is registered with the Securities and Exchange Commission, the SEC. And as such, we act as fiduciaries for our clients. And that means that we must put our clients' interests first. We are very committed to using our team approach to differentiate the service that we provide. This picture is from our holiday card a couple of months ago. 12 of us, soon to be 13, of us working together for our clients and helping them align their financial goals with their values and their lifestyle. So let's start by talking about the history of sustainable investing. And we're really going to talk about these four kinds of things. So when I started in the financial services area in 1985, it was called socially responsible investing, and it had been around for a while. And think about no defense investing during the Vietnam War time, or divestment from South Africa due to apartheid. Some have said at that time, SRI used to be the granola of finance. Since then, the concept has really evolved, and we're going to talk a bit more about the difference between the exclusionary screens, inclusionary screens, advocacy and engagement, and then finally impact. Most of what we will be talking about focuses on money managers that are investing around a specific goal, mutual funds and institutional money managers. And as I said, exclusionary screens really got its start in the late 1960s with a desire to not be involved in the Vietnam War and then later against apartheid. So the first definitions related to exclusionary screens focused on excluding certain industries from mutual funds, military weapons, and then the sin stocks, quote unquote, of alcohol, gambling, and tobacco. And to more currently, a focus on excluding coal mining and oil and gas exploration and production, as well as gun manufacturers. So then we move to inclusionary screens. And so inclusionary screens were historically focusing on companies that were making more of a positive impact. And that has now really been redefined as ESG investing, using environmental, social, and governance factors in making investment decisions. In some cases, using these factors has really started to move mainstream as managers are beginning to understand these factors as a risk mitigation tool. Steve is going to talk about this a bit more, but the belief is that looking at companies through an ESG lens will help avoid problems, potential problems in the future. Some of this are examples of this are the BP and the oil spill in the Gulf of Mexico, VW and the emissions issue. So there are stories like that. So to get more specific, environmental factors are really looking at air and water pollution, carbon emissions, climate change, resources utilization, and sustainability. So sustainability in waste management, biodiversity, deforestation, energy efficiency, and water scarcity. Whereas the social factors are now more focused on looking at how companies are considering employees, customers, suppliers, community, human rights. And so the upshot of some of that is labor standards, gender and diversity policies, community relationships. Governance is one that has gotten a lot of press recently in terms of considering executive compensation, management structure, board accountability, and shareholder treatment. And this area also includes lobbying activities, political contributions, corruption policies, and most recently, California passed a law that companies based in California now have to have at least one woman board member on the corporate boards, and that's a big change. So moving from the exclusionary to the inclusionary to advocacy and engagement, it's really focused on money managers being focused on dialogue with the companies to improve sustainability. Working with Home Depot years ago in creating sustainable forests for wood. According to the Governance and Accountability Institute, 85% of S&P 500 companies have corporate social responsibility reports, which didn't exist at all years ago. Proxy voting has been another important tool as shareholders have banded together to work on shareholder proposals. USSFIF, which is a socially responsible, national organization, and Pax World, which is a mutual fund, report that 271 proposals were filed related to climate change alone between 2016 and 2018, as an example. And more companies are doing assessments of the long-term portfolio impacts of likely climate change scenarios. And then finally, public policy, where companies are working in the public policy arena and organizations working in the public policy arena to promote positive change at the regulatory level. An example of that is working on plastic bag bans, for instance. Then we move to investing for impact. And that's a real conscious effort on to really make investments that will have a positive impact in a couple of areas. One is strengthening communities. So what is the company doing to strengthen the community or communities that they're in, particularly as it relates to money for community development, affordable housing, education, and health. Another area is access to capital. Again, what is the company doing in filling gaps in financing, which might involve considering the diversity of the vendors it uses? Solutions to climate change. here the emphasis is on what companies are doing not only to mitigate risks, but how they can actually support environmental sustainability, renewable energy, and sustainable agriculture. A number of companies are now making pledges to use alternative power sources by a particular year. And the difference here in impact is seeking out those companies to make a positive impact. Stonyfield Farms, Tesla, Warburg Parker were all funded by impact investors with the aim of pursuing both profitability and industry-leading sustainability practices. So positive impact doesn't happen by accident. It's the result of a very intentional investment that addresses a specific environmental or social issue. So at this time, I'm going to pass the baton to Steve to continue talking about the evolution of SRI in its current state, which is now really defined as sustainable, responsible impact investing.
Thank you, Kay. And I also want to thank everyone for joining us today. My experience in SRI investing began in the exclusionary screening stage, as Kay outlined earlier, in working with a consulting firm and then a religious pension firm in my past. Excluding certain industries was actually very common. It evolved to advocacy work at the pension fund I worked with, and actually engaging with companies to try to affect change. At Birchwood, I work with our financial advisors and our clients to construct investment portfolios that are suitable to their financial goals and seeks to incorporate their personal values as well. This has become easier to accomplish as the industry has evolved over the years. One of the more recent evolutions has been the introduction of these Sustainable Development Goals. A few years ago, the United Nations Principles for Responsible Investment published these goals in an effort to provide a universal framework for concentrating investments in areas where the global economy and society can see the greatest benefits. These address the global challenges we face, including those related to poverty, inequality, climate, environmental degradation, prosperity, peace, and justice. The goals interconnect, and in order to leave no one behind and build a brighter future, a more sustainable future, it's important that we all strive to achieve these goals by 2030 as investors. As the integration of these, what we'll call non-financial factors that we're talking about into our investment process has evolved over the decades, these goals now create more of a framework for professional investors to tie their invested dollars to promoting a better future, a better life for future generations, and actually also provide more sustainable earnings for businesses. Here I just wanted to outline a couple of examples. Examples can help illustrate this. And in the first case, we have Mosaic, which is actually based here in Plymouth, Minnesota. This investment manager knows what is measured usually gets tracked, and that financial incentives can actually provide a great catalyst for change. So this manager asked Mosaic to tie their executive compensation to certain sustainability metrics, which wound up opening up dialogue between the manager and Mosaic management. And now this investment firm is working with its executives, with Mosaic's executives, to create a better compensation structure. In the case of BMW, which I'm sure you all know, the company's commitment to reducing its production of fossil fuel-based vehicles is actually seen as contributing to the case for making an investment in the company's stock. This is a business decision that was made by BMW that's likely founded in differentiating its product line, maintaining a competitive advantage in an evolving industry, and it's obviously in line with reducing the environmental impact of automobiles. So it's easy to see from these two examples how good business and these sustainable development goals can easily intertwine. So SRI investing can still take many forms, as we discussed: exclusionary, inclusionary, impact, and so on. And some people choose to tie their moral or ethical values with their investments. Others choose to incorporate religious beliefs in their investment decisions. A substantially growing number of others see integrating these sustainability factors into the decision-making process when making an investment, with the goal of improving their overall understanding of the investment, which hopefully will lead to better outcomes. The CFA Institute, which is a global investment organization, recently issued a statement that integrating ESG factors should be seen as an important part of evaluating any investment. Providing financial incentives to companies, such as a higher stock price or lower borrowing costs, can help usher change. So this can be used to corrupt, as we've seen in many examples over time, or if we tie these to the Sustainable Development Goals, it can actually be used to promote a better tomorrow and more sustainable, better business practices. Countless studies have been performed that, in our opinion, put to rest the question of whether you need to accept lower returns by investing using an SRI strategy. We believe that using an SRI strategy should be expected to provide competitive investment results over the long term. Many investors integrate ESG factors as a means to actually just as a risk reduction tool. And we can easily go back to the examples Kay mentioned of BP or Volkswagen to illustrate how you might be able to reduce your risk by using these strategies. As you can see by the chart here, SRI investing is no longer a niche industry of social activists and religious organizations. It has become much more mainstream, and the amount of money invested in SRI strategies continues to grow exponentially. Some of the largest asset managers in the world, like Vanguard, BlackRock, Wellington, are integrating these ESG factors into their investment selection process. And what's great is more recently, these firms are actually becoming much more active in voting proxies as opposed to simply agreeing with management in the past. There's actually an estimated $23 trillion invested in sustainable investment globally. And as we talked about before, the United Nations, the Principles for Responsible Investment, actually has an agreement for asset managers that they can sign. To date, nearly 2,000 asset managers globally have agreed to these principles, which those asset managers control over $80 trillion in assets. This PRI agreement asks managers to report on their responsible investment activity on an annual basis and encourages them to continue to integrate ESG factors into their investment practice. As you can see, the number of managers that have signed this agreement has been growing by leaps and bounds over the years. And as I mentioned earlier, this using SRI in an investment portfolio has become easier. So there are dozens of investment firms now that offer strategies in mutual funds or exchange traded funds that are accessible to individual investors. Birchwood actually offers an SRI fund options in our own 401k plan. It's been much easier for employers to actually offer SRI strategies in their retirement plans, and we'd encourage you to inquire with your employer if SRI options are available, and if they're not, if they can be available. We do want to note, like anything you buy, you do need to be a smart consumer. Not all SRI investments are created equal. Just by being an SRI investment, it doesn't make it necessarily better than any other investment. MSCI and Sustainalytics, the two groups on the bottom of the screen here, actually provide rankings on companies globally regarding the certain ESG factors that we discussed. So since these tend to be non-financial factors, they can be interpreted differently. The research firm MSCI and others are typically used exclusively by investment firms, or it might be used to supplement proprietary research by investment firms. So a great example recently is PG&E out in California, Pacific Gas and Electric. Depending on the research that you used, some interpreted PG&E's sustainability that they had poor oversight and insufficient investment in improving their aging infrastructure, which led to massive wildfires in California. Other researchers looked at the growing portfolio of sustainable energy sources in PG&E's portfolio as being a positive factor. Ultimately, PG&E is facing bankruptcy and numerous lawsuits stemming from those fires in California. So switching gears a little bit, SRI is most commonly associated with stock investing, as we've kind of talked about thus far. As a stockholder, as you know, you are actually an owner, a part owner in that company, and therefore you have certain rights to voice your opinion. This position has provided investors with a mode in which to seek change and promote more sustainable business practices. A more recent evolution in SRI investing has been the application of ESG factors by bond investors. Bonds are different than stocks in that they are essentially a loan to a company or any other entity. Lenders have certain power as well. They can set terms for how the money is used and can enforce those terms. The entire industry, or an entire industry of so-called green bonds, has evolved almost overnight. These green bonds tie financing to projects that reduce the environmental impact of a company or a municipality. Some of the most prominent green bonds have come from large technology companies such as Apple or Google, as they move to sourcing energy from 100% renewable sources. So here's just one example of how a green bond would work. In South Davis County in Utah, which is just near Salt Lake City, this municipality issued bonds to finance a project that would allow for the conversion of waste into biogas, which is a renewable form of natural gas. This bond provided a competitive return to investors and provided the county with the funds it needed to complete its project, which, as you can see, had a real measurable impact on the source of energy generated by this Utah county. As we wrap up, here are some resources we put together for you if you want to research this more. These are all available to the general public to get more information regarding SRI strategies. And then, of course, we hope that you view us as a good resource for your SRI questions, or if you're interested in learning more about how you could integrate SRI investing into your portfolio. Again, you'll be receiving a follow-up email with a recording of today's webinar and a copy of these slides. With that, I'll turn it back over to Kimberly as we begin to address your questions.
Yeah, it looks like we have a few questions, so I'm going to have Kay take the first one.
So the first question has to do with gender lenses, using a gender lens for investing. And that's really looking at this whole concept of diversity in the workforce and in particular corporate governance, and really relates to that California law that I referenced. And I recently wrote a couple blogs about this that you can find on our website if you want to take a look at some more information about that. But fundamentally, studies are showing that having women on corporate boards is a good thing, and that performance of those companies has outperformed all male boards. So it's something certainly to consider.
Steve, do you have a question you'd like to answer?
Sure. So just asking about the difference between SRI and ESG. We obviously, like most industries, love our acronyms, but just clearly defining kind of how we see the difference between SRI, which we classify that as sustainable, responsible impact investing, versus ESG investing. ESG investing to us really just means looking at environmental, social, and corporate governance factors when you're evaluating an investment. SRI investing is really kind of an all-encompassing term that we use for bringing together your personal values or morals or anything like that into how you're investing. So ESG is just one method that we use within kind of a global SRI strategy. That hopefully clarifies it.
All right, that looks like that is all we have time for today. We want to thank you all again for attending our webinar, and thank you to Kay and Steve for sharing their knowledge with us. Look for an email in the next few days, and we hope you have a great day.